Hi everyone, thank you so much for joining us today. We're really excited to have you here. And before we get started with our guest speaker of today, I just want to quickly show you guys a little bit about syndication, which is a topic that a lot of you are familiar with or heard about. So today we'll be covering how busy professionals really create wealth by investing passively in real estate, specifically using retirement funds, retirement accounts, which Clay will cover in a little bit. And without further ado, I'd like to introduce myself first, real quick. My name is Micy, and I'm the managing partner at Life Mission Capital. I help busy professionals invest in real estate so they can focus on what really matters to them in their life. So, general disclaimer that the following content is only for educational purpose only. Please consult with your advisors before making any tax or legal or accounting related investment decisions. So congratulations for being here today. You're taking one step further into achieving your financial freedom goals. And like what Robert Kiyosaki, the founder of the author of Rich Dad Poor Dad said, financial freedom is only available for those who not only learn about it, but also work for it. So congratulations on taking that step and just further along your education. And then hopefully through this webinar today, you'll have more tools in your toolbox to work towards your financial freedom. So a little about me. I moved to the US at the age of 16. I'm originally from China. I have a diverse set of skills from data analytics, buying, and sales. I started investing in real estate in 2019, first in single family home and then small multi-family. Later on, I decided to leverage my networking and data analytical skills to help people and also myself to passively invest in real estate. And I'll go over a little bit of why in a little bit. But overall, right now, I have 158 units in multifamily across both passive and active and personal investments as well. Now, I'm not only the founder of Life Mission Capital, where I help busy professionals invest in cash flow and commercial real estate. I also founded the Walmart Real Estate Investment Club. That's where I currently work right now. I work in the Walmart side. Walmart supply chain team. But within the Walmart Real Estate Investment Club, we have over 500 members to date as well. And from the progression you see here, in terms of my real estate experience, I really started with just house hacking in the single family space, moving to multi as I was trying to scale my portfolio. And then quickly realized that how much work is really involved in managing tenants and vacancies and repairs. I have property management companies that manage them for me today, but still a lot of work and stress worrying about filling those units. When it's a single family home, when one person moves out, or the tenant moves out, that it's 100% vacancy on the days they're moving out. So it's pretty tough, and that's why I moved to commercial real estate, specifically through real estate syndication. And I'll talk a little bit more about some of the pros and cons as well. And my team, there's quite a few partners. I have the two of them that I work with. Jim Biggs, he's the founder of the GOB network. He controls more than 229 units as a general partner, actually more now because this is from last year. And also he's a managing broker for the state of Indiana, has a professional license in real estate, worked as an agent in the Florida Department of Professional Regulations. And he has a list of other licenses as well, including security licenses. He usually works as a loan guarantor, partner, acquisition, in just raising capital from investors for the investment opportunities. And David Moreau is a close mentor of mine. He's also a CCIM, which is a Certified Commercial Real Estate Investment Member. He is very, very specialized in market analysis and underwriting. In fact, he teaches other CCIMs on market analysis, feasibility analysis, and understanding market cycles. I also have third-party underwriters that I consult with on a deal-by-deal basis as well. But that makes up of our team. And our goal is really to help investors reach their financial goals through exceptional real estate investment returns, and also helping others, including their kids, if they have any, to get to those goals. And we want to make sure we're really living our lives and making those decisions with faith-based values in the process. So you heard about the term real estate syndication multiple times. What is that? It is a way for investors to put their funds, financial, and intellectual resources together to invest in properties and projects much bigger than they could afford or manage on their own. In the past, only the wealthiest and most connected individuals could invest in those, but today, with the technology and the different regulations we have today, it's really being opened up to a lot more people. So there is usually two roles in the syndications. There is the passive investors, also called limited partners. They're the ones typically provide part of the fund that goes into the investment. And then there is the active partners, which are also called general partners or sponsors. Me and my company would be considered part of the sponsor team and the general partner team. So we would help acquire, manage, and dispose the asset when it's time. And while we also provide part of the capital as well to have skin in the game, because we also believe in the deal, while passive investors provide majority of the fund to make the deal work as well. So in general, we work together as a team to make the syndication work and provide returns to all the people involved. So why do I love passively investing in real estate syndications, and why I went away from continue to scale my single family or small multi portfolio? There is major reasons for me, and I found those are the reasons that my investors tend to resonate with the most. They don't have to worry about tenants and toilets. Passively investing means you just need to place your funds on the opportunity you believe in, and we'll keep you updated through quarterly or monthly update, and you can know how our property or performance are going. You don't have to worry about tenants or toilets. And it's a lot more scalable and consistent return compared to a single family, like I mentioned earlier. If you have a single family or even a few multi, let's say 5 units, when one person moves out, your vacancy is already at either 100%. Your vacancy is at your occupancy is at 0%, your vacancy is at 100% or 80%. But when we're able to leverage and pull out funds to invest in much bigger deals, like 100 units or a few hundred units, one person moves out, it's really not that big of a deal. We have other tenants to balance out the portfolio and the vacancies and our income. It is a very tax-advantaged asset class in real estate, and through different methods of cost segregation, bonus depreciations, which may sound like strange words to you, but eventually the government really wants us to invest in real estate, so they give us tax benefits to invest in those, and that will help you with your tax bills. So pay less or sometimes even no taxes through real estate syndication can be achieved. The next thing is diversification and more consistent return. Everyone needs a place to live, specifically multifamily as well, which is one of the asset class that we're heavily investing. And everyone needs a place to live. Rather than, I believe in diversification. I also invest in stocks and crypto, but I also believe real estate is such a strong component, important component in the portfolio. So have more diversification in general. And also when tenants are paying rent or residents are paying rent, whether it's a Ross dress for less in a strip mall or a multifamily, rent is going to be due on a monthly basis. There's a lot more reliability versus Russia and Ukraine is having a war, so stock market is going crazy. So there's just a lot more stability there as well. I also love the fact that it's a lot more limited risks for me as a passive investor, and also for other passive investors as well. I remember sometimes having, a little heart attack over things like, oh, there may be a foundation issue. Oh, there may be black mold. Oh, the roof may be leaking. Those bills can really eat into the profit you just made as a small real estate investor actively. So just spreading the risk across and having people who has done it very well in acquiring and managing it has relieved huge burdens of my shoulder and make me feel I'm more relieved and able to focus on other things I'm passionate about as well. So in terms of real estate syndication returns, obviously varies based on asset classes, the specific deal, and the sponsors as well. Um, Between we and our partners, we have either realized or projected returns between 15 to 20% on an annual basis. That's across a few things between uh, cash flows and appreciations. And it's usually also a 3 to 5 year hold. Sometimes it could be a little bit longer, sometimes it could be shorter. With the recent 2 3 years, the market has been so hot. Most of the deals that was purchased in 2019, 2020, or sometimes even 2021 has already exited just because it's such a hot market. And there has been either realized or projected cash flow between 7 to 10%, depending on the specific asset as well. So along with cost segregations, the returns can be really magnified as well. Cost segregations is basically rather than depreciating the value of a property over 27.5 years or 700 years, we're actually taking that into a smaller chunk of years because maybe lights and fixtures in the house are depreciating over less amount of years compared to 27.5. So essentially separating them into different assets that can depreciate faster. And that will really help us to get better tax advantages on our tax returns. So I know I just went through a lot of things and I spoke really fast. But if you want to learn more, you're already most likely in my network. You can go to my website and look at how to passively invest in real estate apartment syndication. That's an ebook that we have written that has over 30 pages that talks about all the stuff in details. You can also book a time with me or just email me and we can talk more as well. If you're a more experienced investor, I recommend you check out the 110 questions to ask before investing in syndications to understand some of the risks and things to vet through before investing in syndications. So if you have any questions, feel free to put them in the chat or in the Q&A, and I'll be monitoring them throughout the presentation here today. Without further ado, I'd like to welcome Clay Malcolm. He is a creator and presenter of customized educational content related to retirement accounting investment dynamics, and general financial literacy as well. Actually, we really connect on the financial literacy topic, and we probably need to talk more about this some other time as well. He's also an expert in self-directed IRA, HSA, and solo 401k area. So the topic he'll talk about today is how to use your retirement funds to invest in real estate, and more specifically later on syndications as well. So without further ado, I'd like to pass it on to you, Clay.
Hey. Well, thanks, Micy. I appreciate the introduction. And yeah, it was really great connecting with you since we were both had that interest in financial literacy. It's something that's really important to me, and I know that it is to you as well.
Yeah, it is. Yeah, and I didn't mention much at the beginning as I was a little bit rushing through. I wanted to make sure we give enough time for you. But growing up in China, there's just a lot of pressure to study. We studied like 12 hours a day when I was 14 years old, like no kidding. And the whole purpose was to study to get a better job, but people didn't really educate their kids on other options to live a better life, how to budget better, how to invest, and etc. So I think there's a really strong need across the world, not just in the U.S., on those topics. That's why you're here. How can we understand not just to invest in stocks with or retirement funds with our IRA accounts, but much more. So I'll let you take over from here. Thank you.
Okay. Well, thank you, Micy, and thanks everybody for joining us today. My presentation is really about making the retirement account investment knowledge base functional for you. So I do encourage you to ask questions, via the chat or the questions box and things like that. I would love to be able to make this knowledge base functional for you. We're probably not going to be able to cover every detail of it, but I'm happy to pledge my time as an ongoing resource for you as well. But I would like your mind to know that this is a tool in the toolbox that you might need for a couple of different reasons. And when the timing is right, hopefully you'll be able to execute it to your best benefit. So I also have a disclaimer. Mostly because it talks about the way that a self-directed IRA provider works. So all the information I'm going to give today is for education purposes only. At the company I work for, Advanta IRA, we don't give any tax, legal, or investment advice. We don't advocate any particular investment strategy or investment vendor. And we certainly encourage you to use your financial and real estate team when you're doing due diligence on any type of investment that you're considering. The fact that we don't give any tax, legal, or investment advice is really an indicator of how self-directed IRAs work, which is that you as the account holder are really the motive force behind choosing the investments, doing the due diligence, and negotiating the terms. A self-directed IRA custodian or provider, their role is really just to document that activity so that you can connect the tax benefits of the account type with the investment returns of the investment. So that's really the way that equation puts itself together. And again, for our purposes today, just understand that this is education only, and but I'm happy to talk to you about the dynamics of how all this stuff works in whatever detail you'd like. A lot of people ask me, and it's a good question, what is a self-directed IRA? And part of the reason it's a good question is because there is some confusion because the term gets used in a couple of different ways. So let me just say this, self-directed IRA is not an actual account type or a legal distinction. When somebody says self-directed, all they're really talking, it's a marketing or informational term. And all they're really talking about is that the account holder is going to have a say in what the account invests in, right? And so to go back to, to stay in kind of our basics knowledge base here, an IRA is basically an account that gives us some tax benefits for a certain amount of money. And, that money is looked over by a custodian in the case of IRAs. And if we're talking about a solo 401k, it's typically named a trustee. But for self-directed IRAs, there's a custodian that's involved in that process in order to track and document the activity. And so the self-directed part comes in when you have your IRA at a custodian that allows you to make particular investment choices. Now, a self-directed IRA at a bank or brokerage house or something might say, okay, well, we'll be the IRA custodian for you. But while your IRA is with us, it can only invest in publicly traded securities, so stocks, mutual funds, ETFs. Whereas a company like Advanta took the opposite approach and doesn't handle publicly traded securities very well, but handles all kinds of alternatives, specifically for our focus today, real estate. But there are other things as well. So there's, private lending, private equity, cryptocurrency, precious metals. So the IRS actually allows our IRAs, our tax advantaged accounts, to invest in all manner of assets. There's really only a couple of exclusions, life insurance and collectibles. But almost any other asset class is actually allowed by the IRS. So most of us know the paradigm of, I'll contribute some money to my IRA and it'll invest in something. Again, if your IRA is at a bank or brokerage house, that's usually a stock or a mutual fund or an ETF or something like that. But in the case of a self-directed IRA at a custodian that handles alternative assets, such as Advanta IRA, then you actually get to have that money deployed in real estate or some other area that you have an expertise in or that you found a good deal in. And so really, I would say that if you remember nothing else about this presentation, I would say, understand that you as the account holder, as the IRA holder, have the ability to move your money to an IRA custodian that handles alternative assets and to invest in real estate. That's the match you're really looking for, is have your IRA money at a custodian that specializes or knows how to do the administration for the asset class that you want to be in. Understand a couple of other dynamics as well. You're allowed to have multiple IRAs operating simultaneously. Now that could be different account types like traditional and Roth and maybe a SEP and simple and that kind of thing. I think I actually have 5 or 6 IRAs operating at the same time. The IRS kind of sees them all as one or maybe a traditional and a Roth, maybe 2 accounts. But it can be at different custodians for the purpose of investing in particular assets. Now, in the case of Advanta, of course, we handle all kinds of alternatives. So you can have a number of alternative assets in one account. But the idea that I mean to suggest to you with the fact that the IRA, you can have multiple IRAs going, is it's very common for us to have an IRA holder that has an account with us that's doing real estate or some other alternative asset, and also one at a bank or brokerage house, so that they're invested in stocks or mutual funds or any of those publicly traded securities. So as Micy was saying earlier, diversification is really a foundation of a lot of financial plans, and so that opportunity to have your IRA invested in both publicly traded securities and alternatives, gives you the opportunity to do that in a way that you might not have known existed. So again, some basic principles: a self-directed IRA, it's not an account type; it's really a descriptive term. It means that the IRA holder is going to have a choice of the assets that you're going to purchase. And you want to have your IRA at a custodian that handles the assets that you want to get into, whether that's publicly traded securities or some alternative. And there's really two reasons, I think, to understand this knowledge base, particularly for those of us who are real estate investors and inside their IRA and outside it. And I'll just share the fact that I've been a self-directed IRA investor and HSA investor for 10 or 11 years. And I also am a passive real estate investor with my personal funds. So I'm a real estate investor both inside my IRA and outside my IRA. And so I'm one of you, I'm one of us, right? This is something that we're doing actively. And the knowledge base of understanding that a tax advantaged account can invest in real estate and other alternatives, I think has two obvious benefits. One is for your own retirement account. So if you have a retirement account that you've already started, or you have an old 401k, or any type of tax advantaged account, then once you've gone to the pain, so to speak, of contributing some money to that tax advantaged account, that your job as the account holder, the owner of that, is to make sure that that money makes the most money, right? And the reason I say that is because one of the most powerful things about these accounts is that their earnings grow tax deferred. And so they can compound faster than maybe an investment in your personal financial world. So one of the things that I think as a guiding principle is make contributions up to the level that you can, and then get that money working, because the compounding effect will start. And you'll see that as the years go by, that compounding effect, it can be an enormous change in terms of how that money grows and evolves. So, and there are all kinds of self-directed IRAs that can invest in alternative account types and things like that. So there's traditional and Roth IRA, SEP IRA, simple IRA, solo 401k, and HSAs, health savings accounts. So if you have any of those account types, understand that you have the possible ability to control that, put it at an IRA custodian where it can invest in real estate, and have a different sense of control about the earnings that you create. The other thing that I'll say, and this is especially important for those of us who are operating in the real estate asset class, is that if I'm looking to partner with somebody on a particular investment or a syndication or something like that, understanding that the person that I'm talking to is perhaps two investors, right? It's their personal money. Hey, do you want to partner on this deal? But it might also be, hey, does your IRA want to partner on this deal? And one of the things that brings up for me is just that understand that your IRA it's actually a legal and financial entity that is separate from you personally, right? So it has its own name, it has its own bank account, it has its own tax ID number. You get to control it as the account holder. You call all the shots, you're the strategy maker and all that kind of thing, as long as you follow the IRS rules. But it is actually a different entity. And the biggest reason that it's a different entity is because it has different tax advantages than you or I do personally, that our personal money does. So the IRS kind of segregates it, puts it off at arm's length. But it is an investor. And so when I talk to somebody and I say, oh, well, I'm involved in, I want to buy the property at 123 Main Street, but my IRA doesn't have enough money, or my personal funds don't have enough money. Are you interested? And they say, well, sure. They might also say, well, I don't have any personal money to invest right now. And it might be one of those things where you could say, well, how about your IRA or an old 401k or something like that? So do understand that all of us are controlling, at least one pot of money, our personal finances, but we also might be controlling another 2 or 3 pots of money in terms of our IRAs or HSAs or something like that. So 2 benefits: my own retirement account, of course, I get to leverage or use my real estate expertise and my real estate team's expertise to create earnings for my account. But also, if I'm looking to partner or raise money for a syndication or a deal, I know that other people's IRAs might be interested in investing in that as well. So I've covered some of this stuff because I tend to get ahead of myself, but I'll just run through this really quickly. So IRA, this is the IRS's mindset. This is how they see this thing, right? They're giving us the opportunity to put some money into a tax advantaged account to grow for our retirement, right? And there are certainly rules about that. There's annual contribution limits about how much new money you can put in and things like that. But the IRS sees this as an opportunity for us, and they limit that opportunity in terms of how much money you can put in. And they also want to document that activity so that the tax event, whenever that occurs, whether it's at the beginning with a Roth or at the end with a traditional IRA, is what it's supposed to be. So they do require a custodian for your IRA, and they do record all the activity in the account as a legal entity's investment activity, right? So an IRA has, as I mentioned, its own name, its own bank account, its own tax ID number. Now, this money is also going to have some distribution rules, right? A lot of us know what those are. 59.5 is a threshold where the early distribution penalty goes away. For a traditional IRA, there is a required minimum distributions after 72. So there are some rules about that, and you need to be aware that they exist. But as you start to set up this idea of your IRA investing in real estate, make sure to just ask an expert. Often that's your CPA or your tax person, as well as somebody who's in the IRA business, like I am, who can talk about the way that the alternative asset performs within the account. But the idea for us at our takeaway today is, again, this money, the account type's not changing, right? Still that account type is just going to be able to invest in real estate. And so that segues me into this. And again, I got a little ahead of myself, but I'll go through this again. So the account types that are quote unquote self-directed or can be, and in our vocabulary today, we're going to say that, self-directed also includes a meaning that the custodian handles alternatives like real estate. But the account types, they actually stay the same as you're familiar with. So the contribution rules, the distribution rules, as well as the tax advantages stay the same. So you still have a traditional IRA or a Roth IRA. I mentioned health savings accounts has tremendous tax benefits and can invest in alternatives like real estate. ESAs, SEP and Simple are employer accounts. If you're a self-employed person, a solo 401k is a very powerful tax tool and can invest in alternatives like real estate as well. And I did put a little dot on there about former employer plans. So one of the ways that a lot of people get into self-directed IRA investment in real estate is they have a 401k or a 403b, 401a, thrift savings plan, defined benefit plan, some other retirement plan, and possibly at an employer where they no longer work. And once you're separated from employment from that employer, then that money that's in their 401k or their 457 or whatever the plan type is mobile, meaning they can be rolled over without tax and without penalty. And so it's very common for somebody to call me and say, hey, I have a real estate deal I want my IRA to take advantage of. And the money I have to put into that IRA or to get into that position comes from an old 401k where I made contributions before and I no longer work there. So we'll open up a self-directed IRA. They'll do a rollover. Again, no tax, no penalty. You're just moving it from one tax advantaged account to another. And then we'll work on the investment documents to show that IRA is then investing in this real estate offering. whether that is a physical property or a real estate syndication or any number of other real estate assets. So keep in mind that the account types and the rules that are associated with them are the same. The only thing we're really changing is that instead of that money that has been contributed and that is in a tax advantaged state, for lack of a better way to put it, instead of it buying a stock or a mutual fund, it's going to buy a piece of real estate, or it's going to buy into a syndication or something like that, and get those returns instead of stock dividends or the stock price going up or something like that.
Clay, can I ask a question? I think it's relevant here.
Yeah.
In the previous slide, if you go back, if someone has a 401k account at work, but they don't roll over, while they're still working there, that fund is not self-directed. Is that correct?
Well, that's a great question. And 401ks can be a relatively versatile tool. Most employer 401ks do not allow for alternative assets. Some of them do allow you to choose some investments. So a lot of them will say that their 401k plan is self-directed because you are making some choices, but usually it's between several funds or things like that. And if you are, it's an interesting thing about 401k plans. Again, as I mentioned, they can vary some in terms of the rules. Some 401k plans you are allowed to move some money via rollover, even when you're employed there. So it's a great idea, first of all, to take inventory of all the tax advantaged accounts that you have. I mean, make sure that you know how much you have, what money is in there, and how much it's making. What's it invested in, right? And if you have a 401k at your current employer, you may want to ask them if that plan offers something called an in-service distribution or an in-service rollover. The in-service part obviously is indicating that you're still employed there, because you may be able to roll over some of the money that's in that plan even while you're still employed. Now, IRS rules state that once you've separated from employment, that retirement plan is automatically able to be rolled over. So you don't really have to worry about that. But if you're still employed, you might want to ask them, first of all, what are my choices? Because lots of times we take on a new job and we start making contributions and we're not exactly paying attention to our retirement plan all the time. So ask them what the plan offers and if one of the features of it is an in-service distribution. Does that make sense?
Yes, thank you.
Sure. Okay. And since we're talking about real estate, I'm going to start out broad, and then we'll obviously talk more about syndications as we kind of zero in. But your IRA's ability to invest in real estate is really pretty broad. So it can be commercial or residential. You can invest either directly by having your IRA be on title for something, or you can invest in an LLC or other entity, a partnership perhaps, that is then collecting investors and then going out and purchasing a larger asset. And Micy did a great job of describing that in terms of the syndication format. So real estate syndications have become a much more popular investment in tax advantaged accounts or IRAs over the last several years. And a lot of it has to do with the proliferation of information and rules that are allowing the democratization of investment. So the ability of all of us to understand what's available to us and the information that's getting shared it's opening up a lot of opportunities. And that opportunity is moving itself into the self-directed IRA alternative investment space. So we've seen a large uptick in syndications. But that's not the only way to invest in real estate, of course. Your IRA can be a lender. So it could originate loans, whether that's a bridge loan or a construction loan or hard money lending. You can either originate those loans or you can buy existing notes. You can invest in, lots of different types of partnerships. You can also invest in some of the financial instruments that are associated with real estate, like tax liens, trust deeds, things like that. So again, just to give you a flavor of the amount of things you can invest in, really almost anything you have some expertise in, or your real estate team has some expertise in, you can use inside your IRA. Now, typically you have to take a little time to set it up properly at the beginning, but you get to use that expertise in service of making money within that tax advantaged account. One of the other things I'll just mention real quickly is that, an IRA, in addition to having partnerships, can also extend its buying power by taking out debt. And this is more often an IRA that's purchasing a physical piece of real estate. But do understand that if your IRA doesn't have the full purchase price, it can go to a lender and get a loan to extend its buying power. So I think one of the myths that I encounter in IRA real estate investing often is that somebody will say, well, gosh, I only have $10,000 or $20,000 in my IRA. I can't possibly invest in real estate. And that's actually not the case. You can use debt, you can use partnerships, you can get into a syndication, all those types of things. So almost any dollar level absolutely has the ability to invest in real estate. But if you are in the real estate investment kind of asset class and marketplace, you can often deploy funds or amounts of money that are quite a bit less than you might have imagined. So don't feel like you have to have $1 million IRA, to go out and invest in real estate. That is absolutely not the case. And one of the things that I like most about self-directed IRA investing for myself and for the clients that I work with is that you get to use your own team, right? We're not picking the team. The IRS is not picking the team. You, as the account holder, are calling the shots, calling the strategies, but you don't have to do it yourself. So you get to use your trusted real estate team, your trusted financial advisor, CPA, attorney. And I definitely see a lot of folks they have created a real estate investment strategy for their personal funds and then realize, oh my gosh, I can get these same returns inside my IRA. Or I can get the real estate returns inside my IRA and not have to deal with stock market volatility or things like that. So the idea of taking any expertise that you've already created and just basically picking it up and moving it to a very similar scenario inside your IRA is a good one. Now, if you personally already own a property or are already invested in something, that can't be moved into the IRA. So if my choice of words there misled you, then I apologize. You do have to start it from scratch. It's the money that's in the IRA that then goes out and invests in the real estate. But the idea or the system that you use can often be adapted to utilize with that IRA money. And one of the things that I'll just say about our business and what we're doing, because it's important to the mechanics of how your IRA is operating, is that because an IRA is its own legal and financial entity, all of the investment documentation and the paperwork is in the IRA's name. And this is part and parcel to how we work, which is we make sure that investment paperwork has your IRA's name on it, does the proper IRS reporting annually, and that kind of thing. So we get to attach and make sure the tax advantages of the account type to the investment, making sure that the account is in good standing. And in terms of operations, your IRA has a cash position with us, and you basically call the shots on what happens there. Hey, disperse this cash because I'm going to buy into this syndication. Great. So we assemble the investment syndication paperwork, make sure it's in the name of your IRA. On the date that you tell us to, we either wire the money or send it out via check or however you want us to do it to the syndicator, and it's invested in that. And then the returns come right back to that IRA's cash position. Again, in terms of the IRS tracking and the way that the account mechanics work, you're basically operating almost a remote control investor. You tell us when to disperse that cash for the investment, and we obviously receive the returns for you. And then when the returns come back in, you choose, hey, I want to reinvest it. I want to take a distribution. I want to transfer it out. You're in total control of what comes back in. But of course, those earnings come back in tax advantaged according to the account type. So understand that your IRA's cash position serves as a place where disbursements come from or get made to create the investment, and then it also receives the returns. And then you decide what happens with the returns when they come back. And I've already mentioned this, so I'll go over this slide relatively quickly. Your IRA can be an investor on a number of different levels. It can have a cash purchase of a physical piece of property. You don't have the entire investment amount, cash plus debt. You can partner with other IRAs, other people, other companies. You can also even partner your IRA with your personal funds on a property if you want to. So asking or learning about the ways that your IRA can operate obviously can broaden the amount of investments that you might be able to get into, and also the dollar amount with which you can get into those investments. And then obviously the LLC thing is really closely aligned with what we're talking about in terms of syndications today, because a lot of the syndications are in LLC, but it doesn't have to be an LLC structure. It can be partnerships, anything but an S corporation, right? So your IRA can invest in that as well. And when it comes to syndications, the due diligence process, and I stress this because, a self-directed IRA holder is the hub of the wheel when it comes to the due diligence. The investment has to pass your test. We don't do any of the vetting. That's all up to you and your team. And so, we definitely talk to our account holders who are investing, and they talk about the criteria that they look at. And as we all kind of assimilate this information, it's really interesting what criteria are important for what investors. And it's not the same for everybody, but certainly which market you're in is a factor that a lot of people take into account. The principals or the operators, what's their experience, what's their background, what types of properties have they had experience working with, so on and so forth. I always like to think about disposition strategy, especially because IRAs change as you get older, right? So somebody who's under 59 and a half, certainly in their 30s and 40s, their IRA money can be very patient money, right? You can be waiting for the gains to be later because you're most likely and hopefully going to be able to take the distributions later on in your life. So if you're not in a position where you're already taking distributions, your investment strategy might be a little different because the money can be, again, patient. It doesn't have to have cash flow because what you want to do is create cash flow for later in certain circumstances. If you're already in a place where you are taking distributions, then cash flow becomes, usually more important, especially if you're using that cash to live on. And so that changes over time, right? If you start an IRA in your 20s or 30s or 40s or whenever it is, through time, because of the way that the account is set up and its rules, that's going to change. So you might need to think about how old you are in how old you're going to be when the syndication or the investment runs its course. When are you going to need to reinvest? Is it all equity or is it their cash flow? All those kinds of things. So thinking about how you're going to get out of an investment, I think, is a really important thing to think about, especially when your IRA is the investor. Transparency. So obviously every syndication has different reporting capabilities and characteristics. So asking, hey, how am I going to get information about what I'm investing in, whether it's a syndication or any type of asset, is a really important thing. And as I mentioned, the timing of returns. So I kind of already jumped the gun on that one again as well. But this is by no means a comprehensive list of things that you might be thinking about when you're thinking about a syndication, but hopefully it will get your mind started on, hey, how do I digest the information? How do I look at a particular investment and see if it's a match for me? And again, we always encourage you to talk to your CPA, your attorney, your financial planner, your family, whoever it is your advisory team. I mentioned early on that you can have multiple IRAs operating simultaneously, and when you do that, you actually have the ability to move back and forth between accounts quite a bit. And I spent a good bit of time talking about the fact that your old 401k can be rolled over without tax and penalty. And if you are employed somewhere, that you might ask about an in-service distribution or in-service rollover. This chart's actually from the IRS website, and it talks about, can I move money from one account type, the column on the left, to the account type that is represented on the row on the top? And you can see there's a lot of yeses there, right? So the IRS actually gives us more opportunity to move our tax advantaged money around than I think a lot of people realize. So thinking about again, taking inventory of what tax advantaged accounts you have already, and can they be moved? And if they can, do you want to move them to a custodian that handles real estate so that you can start to add that to your portfolio? So again, in terms of basic concepts and things that I would like you to take away, often one of the takeaways for folks who I talk to is that, hey, I have more control over where this money is positioned than I thought I did. So again, taking inventory of your accounts and deciding how it is that you want to deploy that can be a very powerful thing.
Yeah, thank you, Clay. I actually will have a question somewhat related. I know you
Yeah.
talked about a different account, how you can roll over. I have a question about if can the person open a self-directed IRA account while still keeping their 401k in their current job?
Yes, that's a great question. So yes, you absolutely can have a 401k at the job where you're working and also have a self-directed IRA operating simultaneously. Now, and you can be making contributions to the self-directed IRA. You should definitely talk to your tax person about when you have multiple accounts operating simultaneously. You definitely want to be careful about how much contribution you're making and where you're doing that. In some cases, you're going to end up meeting your personal deductibility limit from an IRS perspective, things like that. So there are some rules to think about when you're operating multiple accounts. But you absolutely can, and it's a great way to diversify. So yes. Okay. So last couple of concepts, and then I'm happy to answer questions, and we'll go from there. So one of the things I also get a lot of there are a number of things that can be a little bit confusing about self-directed IRA investing, and one of them is I think people they hear a lot about annual contribution limits, and sometimes they think that means that that's the amount that they can roll over or earn. And I just want to make sure that gets pulled apart for you. So contributions are always new money in, right? And the annual contribution limit is regulated by the account type. So traditional and Roth IRAs, relatively small annual contribution limit. SEP IRA and solo 401k, relatively large. HSAs, relatively small. So the account type it will give you the rule about how much contribution. That's always new money in, right? Once the money is in there, you could make as much money as you want with that money. And frankly, if you're not making contributions or taking distributions or doing a traditional to Roth conversion in your tax advantaged account, your IRA can make $1 million or lose $1 million in a year, and it doesn't affect your personal taxes at all. Right? Again, this is a separate pot of money with its own kind of tax characteristics. So I do want to just, if nothing else, the annual contribution limit does not apply to how much money the money that's already been contributed is making or the earnings. Earnings are unlimited. And also, rollover amounts are not beholden to contribution limits. There are no limits. So if you had a 401k at a former employer and it has $75,000 in it, and you want to move that over via rollover to a self-directed IRA to invest in some real estate, you absolutely can do that. It doesn't have anything to do with the contribution limits. Contributions is new money in any given tax year. So just understand that. And I'll just, again, we're kind of on our end concepts here. A lot of people think that it'll take a long time for their IRA to move over to a self-directed IRA, and that's not the case. So you can have your new IRA opened and have it be dispersing money for an investment in a little over a week. So the application is very simple. It's take you 10-15 minutes. I can have the account open in a business day. Then we're looking at getting money into that account. That's the next step. So now you have a self-directed IRA at a place that handles real estate. You got to get some money in there. So you either make a contribution, you do a rollover, or you do a transfer, or you do some of all three of those. So you're moving money into the cash position at that IRA. And then at that point, you're looking for the investment and negotiating the terms of that investment and working with us on substantiating the fact that investment is going to be part of your IRA. So it can happen very quickly. I would say it's more common for the setup to take a couple of weeks or 3 weeks, but it's not months and it's not years. So this idea that you can't be nimble or agile when it comes to getting your money into a self-directed IRA so that you might meet the funding deadline for a syndication. Don't let that sound daunting to you. That's a relatively common procedure, and it's done in a relatively short amount of time. And then, in spirit of networking and financial literacy, at Advanta, we do a lot of education, and we like people to understand that this tool is available. And we do have an every other week Zoom investor networking event. We can't and don't put investors together with investments, but we do provide a forum where investment providers and investors can, kind of mingle on Zoom, introduce themselves, talk about what they like and that kind of thing. And certainly, you can get some education there, and certainly sometimes there are deals that are kind of started there. So I encourage you to do that. It's free. There's no obligation. If you ever want to join that, you can get to it on the Advanta IRA website, and we're happy to have you, just come and talk with other like-minded folks. And then that's my contact info if anybody wants to write that down. I'm happy to be an ongoing resource for you. I also, as Micy had mentioned about her slides, I went relatively fast, tried to cover some basic topics and concepts that hopefully will get their way into your, financial vocabulary and your thought process when it comes to investing. And that tax advantage money that you may have or somebody else may have could be part of your real estate investment strategy. So, but to go back over any of the details or run a scenario past me, please do feel free to call or email. Happy to talk to you. It's the most fun part of my job. So, so that's my contact info, and I'm happy to answer questions now as well.
Great. Awesome, Clay. Thank you for the great presentation. We actually have a few questions queued up. Okay. Two of them are about fees. Obviously, your company has fees around the different self-directed IRAs, and other companies do too. One person's asking what are the normal fees, and the other person is asking specifically at Advanta, and also annual maintenance fee as well.
Sure. Well, it's a great question. So the IRS does not dictate to IRA custodians, first of all, what assets they handle, and second of all, how their revenue model is built. Most bank or brokerage IRAs, there's the bank and brokerage house are getting commissions from the securities that your IRA buys. But at a self-directed IRA custodian that handles alternatives, more often than not, the revenue model is structured around fee for service. It's almost like hiring a CPA or an enrolled agent to do your taxes. So you actually pay us essentially for our bookkeeping labor, and that I would say is industry standard. So all self-directed IRA custodians, for the most part, are not giving advice or selling assets. And so when their revenue model is built around you paying for the service that they're providing in terms of the documentation and the annual tax filing and things like that. At Advanta, for instance, it's $50 to open the account. That's obviously one time only. When you purchase or sell an asset, you have a transaction fee. For a real estate syndication, for instance, it's $95. And that's obviously only at the very beginning when you get into the syndication, and then when you either sell your position in that or the investment runs its course, you have another transaction fee on the end. So on either end. And then the annual fee, our annual fees start at $195 a year, but they can go up quite a bit. And it really depends on how much activity you have in your account. We have a couple of different annual fee schedules that you could choose from. One is a certain amount per year per asset. And the other one it doesn't matter how many assets you could have 100. It's based on the total account value. So you'd really need to look at the specifics, and our fee schedule is on the website. So please feel free to go in and or email me. I'm happy to send it to you. I would say that it's very common for somebody to be on annual if you're doing 1 to 2, maybe 3 assets or investments, I would say you're looking at somewhere between probably 300 and, I don't know, $600 or $700 a year, and then transaction fees at the ends. So it's typically, in most cases, it's hundreds per year. But again, it really depends on your activity. And the reason that we disclose all our fees up front is because we want you to be able to calculate the ROI, because our fees are part of the equation as well. So please
Great,
do feel free to hit us up for that. Yeah.
great. Awesome. The next question is about if someone opens a self-directed RA account and they also have an LLC, can they have another IRA through work as well? Okay, let me actually just reread the question. Can someone open a self-directed IRA account if they have an IRA through work as a benefit and owns an LLC?
So let me do the IRA one first. The answer is yes. Again, you'd want to talk to your tax person or think about the tax consequences of where you want to make annual contributions, but you can absolutely have an IRA at work, and also one that's personal, that's not tied to an employer. And what was the LLC part?
I think that's just one question. If they could
Okay.
also open a solo 401k through that LLC, right?
Well, yeah. So a solo 401k can be opened by any number of entities. It doesn't have to be an LLC. So you can actually even be a sole proprietor with no incorporation and open a solo 401k. So the solo 401k parameters are usually this: you have to have an ongoing kind of revenue generating business venture, right? So it needs to be creating some sort of revenue for the most part, or at least attempting to. But it could be housed in an LLC. It could be a partnership. It can be sole proprietorship. It could be an S corporation. Typically, it is a solo 401k is just for one participant, so that's the employer or the owner. But if your spouse also works for that company, they can also be covered under that solo 401k plan. So it doesn't have to be an LLC. It can be any revenue generating business can sponsor a solo 401k, and you can have that operating alongside of other IRAs or even other 401ks. Let's say you have a W-2 job and you have a 401k there, and you have a side hustle where you're earning some money and you want that to have a solo 401k. You can do things like that. There are definitely some things, there's some details you want to get about it, but it's possible.
Yeah, I think the person asking the question does have an LLC, and even for some of the investors here, they may have a LLC for their passive or active investment. This may be a tax question, but can they have? Well, what's the maximum if they contribute to their 401k at work and then their solo 401k on their LLC or self-directed RA? What's the maximum through those combinations? Is opening up a self-directed IRA or solo 401k going to help increase the normal maximum? I think it's like 19,000 for 401k, for example. Yeah.
Well, there are some interesting ramifications of having more than one 401k. I will say one thing about this, though. A 401k, typically speaking, has to be an employer that is not a passive investor kind of entity. So the LLC in and of itself may not qualify you to have a solo 401k. So I encourage you to talk to your tax person or your tax attorney or that kind of thing, to see if what you're doing qualifies as a business that can sponsor a 401k. That being said, the 401ks, if they're for totally different things, like a W-2 job, and I'm the manager of a factory, and then I have a real estate business on the side with my solo 401k. Both of those 401ks can max out the employer contributions. The employee contributions are going to be a different thing because, as I mentioned before, the IRS does have a thing called a personal deductibility maximum. So again, you're going to want to think about how it works in with your particular personal taxes when it comes to the employee contributions. And solo 401ks are interesting because they still do have two contribution streams, employer and employee, even though it's one person. So again, consulting your tax person or your whoever is your advisor on in that role, in that realm for you, is an important thing to do. So it's very specific to the person.
Perfect. And I know we're at time. If you need to drop off, feel free. We're gonna stay on, see if there's any remaining questions. I know there was a question asking you to go back to previous slide, but I also had typed that in the chat here, in the Q&A as well. Basically, all the information that, in case you need to get there, you can also look at that as well.
For the network.
Yeah.
Yeah.
Yeah. Well, either one, I think. Yeah, I think the network. Any other questions from? So we have a question: if the money is withdrawn from the 401k to buy real estate, do you know what the tax ramifications are? I guess you can answer from a general perspective. Each person could be different.
Well, the concept that we're talking about today has been that the money is dispersed from the 401k, but it doesn't actually leave the tax umbrella. So I'll make a distinction there in as much as what we've been talking about is the plan, the 401k or the IRA making an investment. So it does need to disperse some money, but that's not the same as taking a distribution. Taking a distribution means that you, as the account holder, are going to personally take advantage of, you're going to withdraw money from the account. That's a different thing than an investment. So it depends on what you're asking. But if you take a distribution, it just follows the distribution rules of the plan. So for a traditional IRA or most 401ks, if you're over 59 and a half and you take a distribution, whatever that gross amount of the distribution is goes on your income taxes for that year, and that's how it gets taxed. One of the things that I will mention about self-directed IRAs is that you could take distribution of the assets that are in the account. You don't necessarily have to liquidate them. And I see this sometimes with physical property. Sometimes people will actually take a distribution of the property rather than having the IRA sell it and have cash and distribute the cash. So there are some strategies there that might come into play as well. But in terms of making a distinction for this question, it would depend on whether it's the 401k making an investment, in which case the money is not actually leaving the account, or the account holder taking a distribution, in which case it is leaving the account. So one is taxed and one is not.
Got it. Another question is, if the person wants to use the self-directed IRA money to invest actively, is there what are the rules around that? Because I know that they can invest passively with the money, but when it comes to active investment, I think there's a lot more regulations around it. Can you expand on that?
Yeah, and the rules for this type of thing for prohibited transactions in IRAs is in the Internal Revenue Code section 4975. If you ever want to put yourself to sleep, you can pull that up. There's basically two categories of things that you have to be aware of. So the IRA account holder, and even the solo 401k trustee, and certain members of their family, lineal ascendants and descendants, they have some restrictions in the way that they can interact with the account. And one of those is providing services, right? So, and when you're talking about passive versus active, the IRS would like for you as the account holder to be passive and at arm's length. And here's why. What they think is that if you're going to be working for your IRA's investment, that you are actually making kind of a non-cash contribution to the account. They don't necessarily know how to value it. They don't know how to tax it, and it just freaks them out. And so that's one of the reasons why the rules about disqualified persons and prohibited transactions kind of came about. It was things that the IRS didn't know how to document very well. And so the thing that I like to say is the IRA holder is always going to be the decision maker, the strategy maker, the thinker. But anytime you start either doing elbow grease, put some elbow grease in, so sweat equity, or doing physical work, that tends to be out of bounds pretty easily when you look at the rules. And the other thing is that if you are essentially providing value to the IRA's investment by your labor, even if it's not physical, you can start to get into a place where that might be considered to be a prohibited transaction as well. So I think it's always a good idea to run that scenario past somebody who's experienced in these types of investments, or an attorney who's experienced in it as a, could be an ERISA attorney, but there are self-directed IRA kind of attorneys as well. It's not written in black and white where every eventuality is either in or out. But there are definitely some limitations, and an easy one to point at is an IRA really can't be a general partner in a syndication because there are obvious contributions, for lack of a better way to put it, being made by that general partner, right?
Yep.
The well-being and the running of the investment.
Yep.
And so that's prohibited, right? That's a pretty easy example. And there's some that are different shades of gray. And you do need to think about how your participation might look to the IRS, because they would like for it to not be considered providing services or a non-cash contribution.
Yep, exactly. That's why I invested only passively through my solo 401k account. There's a question about, are there any limits to how much you can use from your self-directed IRA for investments?
It's a great question, and there aren't any limits. No, you can use, there's no percentage that you have to follow or any of that kind of stuff. Any money that's in the IRA, it can be used to invest.
Got it. And her friend said this in the chat. I'm not sure. Maybe you can comprehend a little bit better what he's saying. Had a business loan via promotional offer 14 years ago with Adventa. Paid it off on time, 0%. 2 years, 5.95. Remainder of balance. Have a great high FICO score right now. So I guess he took a business loan against the self-directed IRA. I'm guessing, Rick, if you want to clarify, but
well,
I'm not sure.
I'm not sure either. One thing I will say though, and this does bring up a nice thing, a question I get asked a lot, is that a solo 401k has the ability for the participant to take a loan from the assets that are in the plan. It's up to $50,000 or 50% of the plan assets, and that money is your personal money. You can take that and go and invest it. You have to pay yourself back, right? You're taking a loan from yourself, so you want to pay yourself back and pay yourself back with interest. But while the money is out, it's actually in your personal financial world. And I definitely have seen people borrow from their 401k for an investment outside of the 401k. They get returns on that. And with the returns, they're also repaying the loan to themselves with interest. So I've definitely seen that strategy, if that's what they're talking about. It's it's something you want to be a little careful with, I think, because it could be a large amount of money. But as far as the rules go, yeah, you can do that kind of thing. IRAs, unfortunately, do not have a loan provision. So people often ask me, hey, can I borrow from my IRA? Or can I personally use my IRA as collateral for a loan? Those two things don't exist.
Got it. Great. Anything else from anyone? I'll give it 5 seconds for anyone to ask any questions. Otherwise, Clay, really appreciate your time and staying over for a few minutes.
Glad to.
Yeah.
Yeah, thanks, Micy.
Yeah, guys, feel free to reach out to Clay or talk to me. I'm happy to share my experiences around using retirement funds as well to invest passively in the real estate syndication space. I think syndication is a great tool that has opened up many doors for us average people to invest and diversify and get the benefits of real estate. So yeah, happy to chat. Either me or Clay about IRA and me about real estate syndication. We just want to catch up and talk about real estate in general. I'm going to stop the recording here quickly. And Clay, would you mind stop sharing for a second?
Yeah, glad to do it. There we go.
Perfect. I am just going to stop sharing, but I wanted to do a quick last because I'll be putting up the um, the slide. The the I wanted to share my contact information here quickly as well, because I'll be sharing this on YouTube. So wanted to
That's
make
great.
sure everyone
Yeah.
has that real quick. Otherwise, that's it. Thank you guys so much for coming. We'll stop the recording and have a great week.